Hi guys, Zaheer Anwari here on behalf of the dynamictrader.com. Can I get a quick screen check and mic check, please? Administrator, thank you. Adinda, fantastic. Okay, brilliant, thank you. Okay, so before we get into the analysis for today, my name is Zaheer Anwari. I'm a senior member of the Dynamic Trader community. I've been trading since 2007 and I am a long-term trend trader. So I look at the monthly, the weekly, and the daily time frame when looking for long-term opportunities throughout all the markets. I don't limit myself to just foreign exchange. I look at foreign exchange. I look at US stocks, UK stocks, and commodities. Admittedly, my two preferred markets are FX and US stocks, and that's purely for the liquidity and the amount of opportunities that arise. But ultimately, I follow the flow of money. You don't want to get caught up in a single market. You don't want to be focusing on foreign exchange 365 days of the year. You want to move to where the money is, and there is a flow of money. Market makers move money from market to market. There's no point staying in foreign exchange if the money's in commodities or stocks. So, be aware of where the flow of money is. Understanding where the money is really comes down to understanding how to read price action and also also having good software. If you have, those two in combination, then, it's very easy to identify where the money is. So before we move into the analysis, I just want to direct you guys to the Fx Apprenticeship Course that I'm doing, the Dynamic Trader Apprenticeship Course. It's this Saturday. It's a month of training. It involves live training. It involves software, community support. It involves a long-term strategy, understanding how to manage your risk, compounding, stops, entry points. Everything is all taught, and the training is this Saturday. The live training is this Saturday, 4 p.m. to 10 p.m. GMT. It's £99 for a month of training. If you're here in the UK, you pay VAT, so it's £99 plus VAT. If you are outside of the UK, you don't pay VAT. VAT is value-added tax, so it'll just be £99, and that's for a month of training. To know more about that and to register onto that, I still do have a few places. Please go to the following website: zaheer.tdtpro.live/about. Okay, I will mention it again at the end of the webinar. All right. Excuse me. Let's just go into the analysis. Let me know if you can see my screen, please. I've shared my e-signal. Can you guys see my e-signal? Administrator, are you able to see my e-signal platform? And if there is anyone else on here, I had some really good interaction with certain listeners last week, which was great, and I got quite a few emails as well at the end of the webinar, which was also great. So can I just get a hello from anyone who's listening in on today's presentation? We're going to be doing something a little bit different today. We're not going to be just doing analysis. We're going to be doing something a little bit more different. I'm going to make it a little bit more educational today. I'm going to give you guys a little bit more understanding of how I actually break down the charts and how I actually look for trends, if you like, in the market. And we're going to be looking at moving averages today. So we'll look at support and resistance, and we'll also be looking at moving averages. So is there anyone out there apart from the administrator that's actually tuned into the webinar today? Could I get a quick hello, please? I don't know if there's a delay between when I speak and when you get my messages, but okay. Doesn't seem like there's many people on the webinar, which is interesting. Okay. Let me just give you a quick breakdown. I will continue as if there are people listening, and hopefully there are people listening. Adi, hello Adi, fantastic. MRC, all okay, good. Okay, well, 2 people is better than none, so I really appreciate you both joining in and tuning into the webinar as always. That's great. Okay, if you guys have any questions regarding what I'm going to present, then we'll do a bit of a question and answer at the end of the presentation. Okay, so as you can see in front of you is a typical chart setup of mine. You guys should be familiar with this if you've been following me for the last few weeks and months across all social media. So what I have on the left hand side is the watch list. So Aussie dollar, US dollar at the top, and it goes all the way down to the South African rand, Japanese yen at the bottom. So quite an extensive watch list. On the top, what I have is the monthly time frame, and the monthly chart has the major levels of support highlighted by this green line, resistance highlighted by the red line, and I have the annual high, low, and close of the previous year. So I've got the high of 2015, the low of 2015, and the closing price of 2015. These pink lines, very significant because not only are they support and resistance, they also tell us what kind of market conditions we're in. So if we're trading above the high of last year, then it's a bull market. If we're trading below the low, then it's a bear market. So ideally, we want to see a price above the high or below the low. If it's trading within the pink lines, then we consider it a consolidation. And this is where I personally would be standing aside. Okay, so the monthly chart gives me areas of support and resistance. In addition to that, what I'm looking at are the round numbers. Round numbers are every 1,000 pips. So if you look at this particular currency, we have 1.1 here, for example, round number. Notice that the resistance is generally around round numbers. So you've got this level here, 1.10. Then you've got the figure 1. Again, a level of support and resistance. Excuse me, it's not always the case. So for example, here, this is more around 0.940. Remember, trading is more of an art, not a science. Round number is here, 0.90, and you can see that's acted as support. If we go the further down, we've got 0.80. It's acted as a level of support and resistance. So it was resistance here, it was support here. You can even see how it's acted as resistance in this consolidation. Right now, 0.70, you can see how price has been struggling. Look at this low point, 0.6. Look at this low point, 0.5. So you can see how significant round numbers are. Round numbers are every 1,000 pips. So the distance between 1.1 and 1 is 1,000. 1 and 0.9 is 1,000. So as a trader, as a trend trader, what I'm looking for is price to move to round numbers. So I'm looking for price to move a minimum of 1,000 pips, really. When it breaks one round number, so in this case, it's currently support. If it breaks that round number, I want it to move to the next round number. That's where I would consider the next level of support. That's what I'm looking for. Ideally, it breaks round numbers and moves to the next round number. Remember, support and resistance levels will get broken when price is in the trend. Don't expect reversals. There are probably more people online, but you have to do some kind of login before being able to chat. All right, fantastic. Okay, thank you, Adi. FX Ambassador, Fed have a rate strategy to go higher. Okay, thank you for that. It doesn't really, as a technical trader, I don't really get caught up in fundamentals. So, whatever the Fed have to say, or Draghi, or anything else regarding that, I don't really get caught up in the fundamentals. I like to look at technical analysis. The main reason why I don't get caught up in the fundamentals is because we are on the outside of the institutions. The institutions get the news well before us. I mean, they're paying thousands and thousands of pounds a month to get news before us, the private trader. And so that news has already been factored into price by the time we hear it. And that could be by a matter of a few seconds. It doesn't matter. Those few seconds are enough for that news item to be factored into the price. But if you look at this, for example, between this high point here and this low point here. So you're looking from July 2014 to January 2016. So how long is that? 6 months, 7 months? The direction of the trend is down. How many news items have come out in that time? How many times has NFP come out? Once a month, 6, 7 times NFP. News generally gets absorbed into the market. There may be intraday fluctuations based on that. There may be even fluctuations based on a longer period, a few weeks or months. But generally, it's in an area of consolidation before a continuation of the trend. So I tend not to get caught up in fundamentals, and I tend not to get caught up in fundamentals and focus purely on price action. Okay, no chart. All right, thank you. Let me do that again. I don't know why that happens. I think that's an issue with Google, to be honest with you. Okay, let me do that again. Okay. Can you let me know if you can see my chart, please? Yep, if you can let me know. Yes, fantastic. No, it's fine. Brilliant. Okay. Okay, fantastic. All right, thank you. Okay. So going back to what I was just saying, if you look at the Aussie dollar, I think you may have missed this, but I'll just repeat it. If you look at this high point here to this low point here, what you're looking at is the Aussie dollar, US dollar on the monthly chart. The trend is down, and that is from approximately June 2014, around that level, all the way down to current times, which is obviously February 2016. So you're looking at, 6 months, approximately 6-7 months. Excuse me, what am I talking about? 2014. So you're looking at a year and 6 months. Sorry, far longer. For a moment, I thought we were still in 2015. So yeah, far longer. You're looking at a year and 6 months, a year and a half. Look at the direction of the trend. In that time, think of all the news items that have come out. Think of all the times you've had to catch up with what the Fed has had to say. Look at all the times NFP has come out. Look at all the interest rate hikes, etc., etc. What's happening with the euro? All of those, different factors that come in that people get caught up in on a fundamental level. Look at the overall direction of the trend. It's not news gets absorbed. The market does what it does. As private traders, it's far easier to focus on price action itself than, get caught up in the fundamentals. Okay, so the monthly chart is where I look for support and resistance. Now, the weekly and the daily chart is where I look for trend, direction, and alignment. And I break this down into the bias and the trend. A lot of the times people mistake the bias and the trend for the same thing. It isn't. I'm actually going to go to the euro dollar for this example. Okay, so the bias and the trend are actually two different things. So if I start with the daily time frame, if I open it up, what you have is a naked candlestick chart pattern. Okay, so we're all familiar with candlesticks. What I want to know is whether the bias is predominantly bullish or predominantly bearish. And by knowing what the bias is, I'm then able to determine whether I want to go long or whether I want to go short, or whether I want to stand aside. So the way that we determine the bias is by using the 200 simple moving average. So there you go. People often ask me whether it's simple or exponential. There's not really much difference in where it's located on the screen. I mean, look, there's the simple and there's the exponential. Simple, exponential. There's not much difference. Exponential obviously puts more weight on current price action. I keep things simple and I keep it simple. Okay, so you're looking at the 200 simple moving average and the price source is closed. So now by having the 200 moving average on the chart, we know whether we are predominantly in a bullish market or a bearish market. So if price is trading below the 200 moving average, this is where I'm looking for shorting opportunities. If price is above the 200 moving average, this is where I'm looking for long opportunities. I don't go against the bias. So I don't go long below and I don't go short above. It's very, very strict. Short below the 200, long above the 200. Now, something that you guys need to remember, and I know there's a lot of people who've probably heard me say this repeatedly. There might be new visitors on here as well. The logic of the 200 moving average comes from before the internet. So traders had to draw everything by hand. Everything was calculated by hand. Candlesticks were calculated by hand. Chart patterns were calculated by hand. Moving averages, everything that was on the chart was all done by hand. It was very, very, very time consuming. So what this meant was that traders were very, very particular with the information that they put on their chart. The 200 moving average was proven to be a very good indicator of the long-term trend. We use that same logic today. In trading, you don't need to reinvent the wheel. In fact, you shouldn't reinvent the wheel. The wheel's already in motion. There's a rhythm to the markets that's been in play for decades. And we just simply need to embrace that understanding, embrace that logic, and use it to our advantage, in addition to a massive advantage that we have, which is software. Because we've got software, we don't need to be drawing the 200 moving average by hand. The software does it for us at the click of a button. But that doesn't mean we should change our approach. We still need to have that long-term approach. That's the smarter option. Okay, now we have the 200 moving average also on the weekly time frame. Same thing. So if you look here, 200 simple, price source is close. So now we have the 200 moving average on the weekly and the 200 moving average on the daily. So what I'm looking for is price to be below both moving averages in a strong bear market, and price to be above both moving averages in a strong bull market. Sometimes we need to wait for that setup to appear. So if I just take back price action, if we look right here, this is where price broke the 200 moving average on the daily time frame. But if you look at it on the weekly chart, you can see where my crosshairs are. If you look at it on the weekly chart, you can see that the 200 moving average is around this level here. So when price broke the 200 moving average on the daily, it bounced to the upside. That is because it was between a level of support resistance and a level of support. So the resistance was the 200 moving average on the daily, and support was the weekly 200 moving average on the weekly. So what we needed to do was wait for price to not only break the daily 200, we also needed it to break through the weekly 200, which was around this level right here. So you can see how long we had to wait. The initial break happened in May of the 200 moving average. The break of the weekly happened around August. So you're looking at about 3 months, 4 months before we had a breakout to the downside. That is where we had alignment between the weekly and the daily time frame. One of the hardest aspects of trading for many private traders is applying patience to their trading. FXB, which are round numbers on Japanese yen pairs, we'll come to that. Okay, we'll have a look at that. So please remind me of that question towards the end. Okay. So patience is an element of trading that a lot of people find really, really difficult to apply to their trading. That is because of the way we are sort of, if you like, programmed to make money. We go to work, we work a 9 to 5, we work a set number of hours, and we then get paid hourly, weekly, monthly. Ultimately, you get paid for the effort that you put in. And if we don't, then there's always uproar and, you know, I should have got paid more money, etc., etc. The point is that you get a certain amount of money for the hours that you put in. What you're having there effectively is instant gratification. You're doing your work and you're getting paid for it. In trading, it's not like that. Money is not made in periods. Money is not made on a daily basis. Money should not be targeted on a daily, weekly, monthly basis. I hear a lot of people saying that they want to make 10% a month or, 100 pips a day. It's a very, very, very difficult way of trading, if not impossible. The way to make money is in periods. And this is where trends come in. So you could make, let's say, for example, in foreign exchange, if you look at the length of this trend, the length of this trend started in May 2014 and went all the way down to March 2015 before going into consolidation. So you're looking at, almost a year of trend. And you don't even need that whole trend. You just need the middle of it. You need a section of it. Within that, you could get excellent growth. I'm talking about 20, 30, 40%, a single trend, potentially even more if you know how to compound. So allow the factors to line up. Let price break the weekly and the daily to determine a strong bearish market, or the other way around in a strong bullish market. Okay, now, if I open up the daily chart, what you can also see, if I just move back price action, what you can also see is that even though we have a predominantly bullish market, we have areas of where the trend is up and the trend is down. So ultimately, you have short-term and medium-term trends in an overall bias. So as long as price remains above the 200, it has a bullish bias. But here the trend is bullish, here the trend is bearish. Here it's bullish, bit bearish, then bullish, bearish, bullish, bearish, so on and so forth. So what we need is a way of determining whether the trend is also bullish and bearish, not just the bias. And the way I do that is by using the 50 moving average. Again, you can see that the 50 simple moving average, price source is close. Color it blue just to differentiate it from the 200. Okay, so now what can we see? Well, when price is trading above the 50, it's a bullish trend. And when price is trading below the 50, it's a bearish trend. So two things to note. What we're looking at is the trend and the bias. The trend and the bias, they're two different things. What we're looking for is alignment between the trend and the bias. So if price is trading above the 200 moving average, I also want it trading above the 50 moving average. If it trades below the 50 moving average, above the 200, then I stand aside. I want a bullish bias and I want a bullish trend. Below the 50 moving average, below the 200 moving average, I want it to be below the 50 moving average as well. So it has a bearish bias and a bearish trend. If we take price action further along, you can see here where price broke above the 50 moving average. This is where the trend went from bullish. This is where the trend went from bearish to bullish, but the bias is still bearish. I hope you guys are grasping this concept. Unfortunately, I can't write on here. I don't know if Google has tools where I can actually write. I can't see. I'll have to figure this out. I'll have to figure this out for the next time we use it. But it would be useful if I had pens, etc., for me to actually write this. I'll speak to the administrator next time, and I'll be able to be a little bit more proficient with this. Okay, but just to summarize that, above the 200 moving average, the bias is bullish, and I want price to also be above the 50, suggesting a bullish trend. So I want the trend to be bullish and the bias to be bullish. Below the 200 moving average, the bias is bearish. So I want the price to be trading below the 50 moving average as well, so that the trend is bearish. Now notice what happens. When a trend establishes itself, what we want to see is, in a bear trend, we want to see the 50 moving average acting as a level of resistance. And look how it respects that. It breaks below in May 2014, and then it comes back to retest it on numerous occasions before eventually breaking it in April 2015. So you're looking at about a year of trend there. As soon as price breaks the 50 moving average, then potentially you're in a trend reversal. The euro dollar was a very profitable trade. I shorted this for 1.3. So I waited for this whole area to set up. So I didn't trade any of this. And then when price broke below 1.3, this is where I started trading this. I compounded all the way along this trend, and then eventually got stopped out around this level here somewhere on this pullback. And that's a 2,000 pip move. So 1.3 down to 1.1, that's a 2,000 pip move. But through compounding, I leveraged that to over 15,500 pips. And that's the power of compound growth. And that was 5 positions with multiple lots, each position no more than 2% risk. Okay. And now what can you see? Well, when price is in an area of consolidation, it just kind of zigzags. And you can see that the 50 moving average is quite flat. The 200 moving average is very flat. So we have indications that price is in a consolidation. And this is where range traders will draw resistance and support, and they'll go long off support and short of resistance. But remember, guys, that trading within a consolidation carries a far greater risk of losses. Trades are shorter, so you can't compound. And because trades are shorter, people start over risking. You carry a much greater chance of whipsaw moves against you. So price doesn't move very cleanly between resistance, support, resistance, support, resistance, support. You can't look at this movement. It's all over the place between a high and a low. You're better off staying out of this market. I always see people getting very excited about the euro dollar on a daily basis, but you can see very clearly here that this is not a market that you want to be getting involved in. Okay, now in addition to the daily chart, I want to see the same on the weekly chart. So if you go back to the weekly chart, if I go right click, edit chart, and I also have the 50 simple moving average right there, 50 simple close. And so what I'm looking for is alignment between the daily and the weekly time frame. So on the weekly, I want, in a bear market, I want to be below both moving averages. So that will suggest a bullish, that would suggest a bearish bias and a bearish trend. And also on the daily chart, I want to be below both moving averages, and that will also suggest a bearish bias and a bearish trend. If I don't have that setup, I stand aside. So if you look at the moment, we are below the 200 on the weekly, above the 50 on the weekly. And if you look at current price action, we're above the daily 200, we're above the 50. So there's no alignment here. Below the 200, above the 200, above the 50, above the 50. We want to be standing aside in this condition. And by looking at the monthly chart, we can see that it's in a consolidation anyway. Look at that trend. Look at that move to the downside, consolidation. As long as it remains in these pink lines, it's a consolidation. I want to see price break up to the upside or break out to the downside. Bias is always with the downs, with the trend. So in this particular case, the bias is with the bears. So ideally, I want to see a correction to the downside and a continuation of the downtrend to 0.80. Okay, I'm just going to go to the chat box just to see if there's any questions that I've missed. What do you mean by compounding? Investor, your name should suggest that compounding should be integral to the way you trade. Compounding is simply, if I explain it in terms of arrows, let's say, for example, let me just get my drawing tool. Okay, let's say, for example, I take my first position at this point. Okay, so this is my first position. So it starts returning me a profit, and I'm doing really well on my first position. So now, because my first position is returning me a profit, I don't want to go and risk on another currency. So what I'm looking at here is the euro dollar. So the euro dollar is saying, hey, I'm giving you profit. Why would I want to go and trade the Aussie dollar US dollar when the euro dollar is already suggesting profit? So what I will do is add another position here. So now what I have is two positions running side by side. When the second position runs into profit, I will add a third position. So now I have these three positions running side by side. Then I'll do it with a fourth position, and then I'll do it with a fifth position. So by the time I get stopped out, I have 5 positions running along the length of the trend. And you can see that the first position was running from here all the way down to here. So that is what compounding is. Another terminology people use is scaling in or adding. So all I'm doing is adding to my winning positions. Okay, so rather than diversifying my portfolio, I simply continue adding onto that same winning trade. It's the technique of people like Warren Buffett. I know he's an investor, so he'll do it differently, but ultimately he's used compounding. If you look at Warren Buffett, before he turned 50, he had only 300 million. I say only, he had only $300 million. Now he's got 80 billion, approximately $80 billion. So to go from $300 million to $80 billion in a 30-year period, that's a staggering growth. And that can only be achieved through compounding, holding and compounding. You won't achieve that kind of growth through day trading. Because day trading, you have winners, losers, winners, losers, winners, losers. But at the end of it, you just cancel all your winners out. So you really need to look at people like Warren Buffett, the turtle traders, John W. Henry, Jim Rogers. Look at these guys that have achieved growth and understand why they have achieved growth and why so many traders today, private traders, are losing money. Okay, so I hope that answers your question there. No, it all comes down to, okay, one of the questions, but if the trend returns, my losses will be greater if I have many positions. You'll have stop losses. You'll have stop losses in place. So you'll have a trailing stop loss in play. You always eliminate risk on the first position. So let's say, for example, you're risking 2%. You move your stop loss to your entry on your first position when you have a second position running. So, you have to have a way of managing your stops, and you've got to have a way of managing your exit so that it allows the trend to develop. If you look at the euro dollar, you can see there's pullbacks. Look at these pullbacks in the euro dollar. I had stop losses in play that allowed for these pullbacks. Look at this move to the downside. If I keep on getting stopped out, I would have missed out on this one move across 5 positions. So this move, which was from around, let's say 1.22 all the way down to 1.12, let's say that is a 1,000 pip move. I had 5 positions running. That means that 1,000 pip move leveraged to 5,000 pips. And if I had 2 positions running, 2 lots in each one, that's 10,000 pips. So, you've got to really sort of focus on exit management, risk management, stop management. It's not just about an entry point. And this is where a lot of traders go wrong. They found an entry point. They have a 1-to-1 risk to reward ratio. They get in, they take their trade, happy days. Okay. But it's not as simple as that. There's more to trading. Trading is a business. You've got to understand a lot more than just understanding an entry point. Okay, yeah, I have remembered your question. Okay, let's look at the Japanese yen. Now, the Japanese yen is a currency that you do want to keep an eye out on, and we'll go through the analysis. Okay, so first of all, let's answer the question. With Japanese yen currencies, you're looking at hundreds. So I don't know if you've been to Japan, but in Japan, they have the 100 yen shop. 100 yen, say, for example, in here, I'm in London, we have the £1 shop. In America, you probably have the $1 shop. In Japan, they have the 100 yen shop. So the 100 yen is effectively £1. What you're looking at here is hundreds. So let's say, for example, if we start here, you've got 200. Next round number is 210, 220, 230, 240, 250. Okay, that's what you're looking at. Here we've got 100, 90, 80, 70. Go the other way around, 100, 110, 120. So it's the same thing, just in hundreds. Now, if we look at what's happening on the monthly time frame, if I just open it up, look at the weakness to the downside. We're starting to see momentum. It's trading below the low of last year. So that is a really good sign that we're in bearish territory. It's broken out of this long-term consolidation. So there's a low of that consolidation. This is going back to December 2014. The longer the consolidation, the bigger the breakout. And you can see that this has trended very well in the past. This trend here and this trend here, these have been very profitable for me. In these areas, I stand aside. I'm now looking for an entry point into this particular currency. So this is very much on my watch list. Let's have a look at the weekly time frame. Now, what we have is price trading below the 50, suggesting a bearish trend, but above the 200, suggesting a bullish trend. Okay, now, let's be a little bit smart about this. The distance between here and here is around what we're looking at. 104, let's say 200, 400, 600, 800, 1,000. So let's say approximately 1,000 pips between this point and this point here. I would trade this, even though I am trading it against a major bias. I would trade this, but I would do it at reduced risk. Why would I do it at reduced risk? Because on the daily time frame, we're below the 200 and we're below the 50. We're seeing good weakness to the downside. Look how quickly it's moving, guys. So I've got pretty much all my factors lined up. I'm below the low of last year. I'm below the 200 on the daily. I'm below the 50 on the daily. I'm below the 50 on the weekly. I'm above the 200 on the weekly. Just because of this scenario, the one scenario, doesn't mean I'm not going to take the trade. What I'm looking at is the distance between here and here. And that is 1,000 pips until the next level of support. Okay, we got the round number, 110. And we can see how it's reacted to that. So, but the distance between there and there is 400 pips. So I'm still going to trade that. Then another 600 pips to here. So potentially 1,000 pips worth of movement. I would take this trade, but I would reduce my risk. So ordinarily, where I trade 2% per trade, here I'd be risking 0.25% or 0.5% because I'm trading against a major bias. Okay, so this is where trading comes in as an art. You have to be able to understand your market conditions and then be able to manage your risk accordingly. Okay, I hope that answers your question there. FXB investor, I hope I answered your question. So let's have a look at one more currency. Let's have a look at the pound yen. Okay, so the pound yen is a currency that I do have positions running on. Weakness to the downside. Good weakness to the downside. So since what we're looking at, December, January, February. Notice the movement in December. A lot of the times people assume that December is a very quiet month. But look at the movement. December, January, February, momentum to the downside. If it breaks this low point here, which is the low of January, then we'd like to see a continuation. Ideally, we want to see this continue all the way down to this major level of support, which is around 140. If it clears this, then down to here. So you can see how useful looking at support and resistance on the monthly time frame is. Right, now on the weekly time frame, we're below the 50, but we're above the 200. But look at the distance between here and here. Yeah, you were looking at 200. What we were looking at, 400, 800, 1200. Yeah, a good significant amount of pips. And so I started shorting this around this level here. Good profit, held through the pullback. Bearish tram tracks formation, weakness to the downside. If it breaks through the weekly 200, then we could see further weakness. That's what we're looking for now. On the daily time frame, below the daily 200 and below the 50. So we have a bearish bias and a bearish trend. Look at the movement. These are daily bars. Look at the momentum to the downside. This is the direction that you want to be going in. And look at the strength of the movement. These pullbacks are short-lived. Price is simply just going straight on. So you want to find a good entry point into this. And this is a very good example again of the longer the consolidation, the bigger the breakout. Patterns repeat, guys. It's as simple as that. Patterns repeat again and again and again. Okay, that is me for today. Let me just go to the questions. Are there any final questions before I call time on today's webinar? Okay, guys, if you are not following me, here are some contact details. Please contact me on the following email, zaheer@tdtpro.com. Trend traders have more losing trades than winning trades. Is this the same with your system? Okay, I wouldn't focus on how many winning trades and how many losing trades. I could have a success rate of 5%. Let's say, I'm not saying that I do, but let's say I have a success rate of 5%. My 5% are large compounded winners. My 95% are all tiny losers or break evens, for example. Okay, so don't focus on how many winners you have. That's a very common approach to trading, but it's not the correct approach. Focus on how large your winners are. Remember the philosophy: cut your losers short, let your winners run. It's all about having large winners, not many winners. What is the view of the pound? 1.48 doable. I would say that the pound, let's have a quick look at the pound. If you look at the monthly chart, 1.48 doable. I don't really sort of get caught up in areas of consolidation. Price is simply faced with support here and support here, and that's why we've got a bounce to the upside. If I'm looking to trade the pound, I would want it to break above the high at the earliest, so 1.6. And if I was trading it short, then I would want it to clear this whole level here, and that's when I will trade it to the downside. The pound dollar is not one that I would personally be looking at. And guys, remember, this is all part and parcel of being a good trader. Don't have an attachment to any single currency. Your attachment to any currency should only be for as long as it's paying you. If it's not paying you, then you know, don't trade it. This is not your relationship with anything. Your relationship with any currency, any stock, any commodity should only be for as long as there's growth happening on your account. Okay, so stay away from just thinking that you need to trade just the majors. You don't. Okay. So I hope that answers your question, MRC. Contact me, Zaheer at tdtpro.com. Guys, if you're not following me on Instagram, then please follow me right here. My Instagram handle is fx.mentor. And I put out a lot of posts and I put out a lot of notifications as well. I'm doing daily Periscope. So if you guys are on Periscope, please follow us on Periscope, which is at Dynamic. I'll just put this in, at Dynamic Trader. Please search for us on Periscope. I do live broadcasts every single day. If you don't have Periscope and you want to watch it on your computer, then you can go to the following link right here. This will take you to our at Dynamic Trader Periscope. There are a couple of Periscopes that I did yesterday and today. They are still viewable for the next few hours. And finally, for the live training this Saturday, please go to the following website. There are a few places left. It's £99 for the live training and a month of support software, live weekly webinars. There's a lot more that goes into it. So please check out the following links. And if you do have any questions, then of course, email me on Zaheer at tdtpro.com. Okay, guys, thanks for your time today. Have a good morning, afternoon, evening, wherever you are, and see you next week. Thank you all. Take care. Thanks, administrator. Thank you. Bye-bye.